Well, hello everybody. We can't see everybody because we've obviously got the screen with the slides on, which we're happy to share with you afterwards. And just to let you know that we are recording this, so if anybody wants a recording of it, we can send it back to you to review again, and it might post some more questions. So, welcome to our event on looking at your company future, and in particular to understand about employee ownership trusts. And I'm really delighted to be here today with both my managing director, Poonam, who is going to talk later on about communications, and Paul, who is the senior partner at Trudgill, Paul, who's a senior partner at Keebles, who is going to talk to us about the legal process, and Russ, who is a wonderful tax advisor from the Tax Advisory Partnership. So we hope we've put together what we may call a killer team. What we're trying to deliver as part of everything we do on here is to offer, if you like, a one-stop shop. So the process of doing this involves a number of stages, and each of the assembled parties are going to provide an important part of that. We don't mind taking questions as we go along at all. Poonam is in charge of the Q&A session. But if you wanted to put your hand up and ask anything as we go along, that's fine. If you want to wait till the end, that's not a problem either. So Poonam, if you'd like to turn to the next slide, please. So I'm going to start and talk about this, and I can genuinely speak from the heart because at FDS we are ourselves an EOT, an employee-owned business, and I'm quite passionate about this, and I'll explain my little journey to where we've got to. So when people talk about, why should you do this, I can tell you why we did it and why it's been so successful. And we're delighted that we've done a number of these since we actually completed our own process last year. And we're now really getting quite good at understanding the nuances of what works and what doesn't work. So I hope that you will use this assembled team of hopefully experts to help you decide which is the best route for you. So when you're thinking about share transfer, there are a number of things that you can do. You can look to sell the company, a trade buyer, and there is no doubt that there are trade buyers out there, but such transactions take time. Generally, a trade sale can take as long as 12 months or more. You can sort of look at a private equity investor, and again, private equity investors are very keen on doing transactions at the moment. They haven't done loads of them because of COVID, and so they're sitting on some piles of cash. However, dealing with private equity brings its own set of challenges, not least of which that you would almost certainly have to be involved long-term.
Yesterday was the return of confessions, and what a great starting confession we had. Was on holiday on this, right? And she had a pain in her chest.
Rachel?
I should mention that since I burn easily, I was.
Can anybody hear this noise in the background that I can hear?
Down to peer at my.
Can we just pause a minute, everybody? It's like I can have an invasion of the body snatchers from. Always going to be Andy, but thank you, Andy. I really like to be part of the Sky News bulletin on my Zoom events. So I'll get back in the throw of this, everybody, and thank you very much. So there are other ways of disposing of your company, but they all come with different challenges, not least of which is time. So one of the beauties about transferring the company to your staff is the speed of the process. Generally, we can take this whole process through in a matter of months, as opposed to months and months on a trade sale, which, as I mentioned earlier, could take at least 12 months. So how does it work and why should you do it? So first of all, the company is transferring all its shares to another company, and that is a trust company that owns those shares on behalf of all the staff. So no individual member of staff owns the shares. It is the company itself, the trust company, that owns those shares. And it's very interesting for the staff because A, they don't have to pay for those shares, but of course they can participate positively in the performance of the business. And by that, I mean that they can actually have a share of the profits. And the great thing for the staff is that £3,500 worth of distributable dividends can be paid to each member of staff completely tax-free. So there's your first benefit for your staff. They are now effectively owners. They can participate in the profits, 3,600 tax-free, and they haven't had to make any payment for those shares. So essentially, the first thing you're doing is passing on your business to the next generation for those people that have helped you build and develop your business, but it isn't going to cost them. Now, traditionally in a management buyout, particularly where it is funded by either bank debt or indeed private equity, those individuals would have to put some of their own, what we call hurt money in it. That does not happen in a EOT transfer.
We've just had an interesting question through. Do you have to transfer all 100% to the trust, or can it be tranches?
So thank you very much, Owen. I saw that question, and the answer is you do not have to transfer 100%, but you have to transfer over 50%. And you can only do this once in a tax year. If you transfer over, and I did originally transfer over 89%, I decided to keep 11% when I did this transaction. The second part of that transaction, if I hadn't done it before the end of the tax year, I would not get the same tax benefits. So you can only do it once and get the tax benefits. So I actually decided to transfer the whole lot over within the tax year because I was concerned that perhaps Rishi may affect the tax benefits that I'm going to just talk to you about in a moment. So the business passes to the next generation. It doesn't cost them anything. Therefore, they're very engaged. And of course, you are effectively rewarding those people who have helped build your business. So now we've retained those great people. What it also does is it helps you attract new staff. Because if you like, as part of your engagement with future employees, you're saying to them that not only do we have a great business, but that you are effectively an owner in this business. And when we make profits, you will be able to have a share of those, and some of those shares are paid tax-free. The best thing, of course, for the vendor, and this perhaps goes some way to answering Owen's question, is that when the transaction occurs, all the proceeds of the transaction pass completely tax-free to the vendor. So there is no capital gains tax at all when you do a transaction with an EOT. But only when you do that transaction either in parts or in one go within a tax year. I've also mentioned that it is much faster. And I think that Paul and Russ and Poonam will confirm about 3 or 4 months maximum, dependent on the complexities of what we might be looking at in terms of additional stuff that you might want to consider. But it's at least 3 times that to do a more traditional deal. One of the reasons I did this was because we believe at FDS we are a bit of an unusual business in that our values don't necessarily align with the similar values that are held in businesses that operate in our sector. Our values are be kind, work hard, stay positive, have fun, not what you may think are as normal values for so-called hard-nosed corporate financiers. However, they're very important to us, and our staff are very special and have been engaged on the basis of those values. And whilst I was starting to look at succession planning in my business, and I looked quite genuinely at perhaps doing a JV with other companies, of selling the business to a trade buyer, I was very concerned that those special values that I've spent 30 years building would evaporate. And I also wanted to say thank you to the people that have made this happen. And without a doubt, I can tell you that it's made our business much more collegiate. Not that we were ever anything than one team, but now we feel we're all in this together. And so it's worked wonderfully for my business. So just if we just go on to the next slide, I'll just show you the sort of organogram. So Owen said, if you transfer the shares to a trust with no payment from anybody, where do the proceeds of sale come from? I'm assuming the rest of the question says that. So Owen, what we did at FTS and what we've done with our clients since this is any excess cash in the company, once the business has been valued, you as vendor take out at the completion of the transaction. So I took out all the excess cash in the business, and then you agree a payment plan for the balance out of the profits of the business. Or alternatively, and I've chosen not to do this, but we are working with clients who have decided to do this, the trust can borrow the money to pay the vendor. Of course, then what you do is you put debt in the business, and we have no debt in our business. But if you are used to having debt, and at the moment you're relatively free of debt, it's totally possible for the trust to borrow that money. So you can either take it in stages, which is what I'm doing, with the first tranche coming out of the cash reserves that we've got, and then future payments coming out of future profits, or the trust can borrow. So the first thing to do is to assess, is the EOT right for your business? And is it right for the vendor? Is it right for the staff? Is it going to make them feel engaged? Because one of the things that we have to make sure is that the revenue are comfortable that this is being done for the right purpose. From a vendor's point of view, although the cash extraction tax-free is very appealing, this has also got to be done for the right reasons in terms of engaging with the staff. Is it the best process? Is it going to get the best deal for you? So once we've done that, then we have to do a completely arm's length valuation. And that, alongside our justification for why the EOT is the right thing to do, goes to HMRC. And then we work with Russ, our tax expert, to make sure that we get revenue approval. And just to give you a little bit of comfort, so far we haven't had anybody turn down for revenue approval, because we put together an extremely robust business valuation that would be very difficult for the revenue to challenge. It's fully researched and documented, providing examples of businesses in the sector and the multiples they're going through and the rationale for the valuation. Then we've got to look at what role you want. Now, we have done some transactions where the vendor has chosen to exit straight away. So the vendor is taking their money and going off into the sunset. In my case, I didn't want to do that because I still love my job. I'm still, I hope, providing a very valuable contribution. And so I agreed that I would remain with the business as CEO. So I still sit on the board, and as I've always done, I run the company with my fellow board directors, and that was my role. So then the trust company is all set up, and we now involve the lovely Paul, and he sets up all the legal agreements, and some of the things that are put in place, and it's been put in place in my company, are what are called reserved rights. So there are certain things that cannot happen until my funds are paid down. Clearly, if the trust was borrowing the money to pay the vendor, that wouldn't be necessary to do that. I have also agreed to my role, not just being a CEO of my company, but I also have a seat on the board of the trust company. And the trust company is formed of myself, my managing director, and then an independent trustee. And an independent trustee is a mandatory requirement of this. And in our case, our independent trustee is Paul. But it can be anybody as long as they can be justifiably classed as independent. And the trust board meet much less frequently from the board of directors, who in our case meet as we've always done and run the business as we've always done, only referring to the trust board for certain issues that may concern the trust members. A very important part of this process we've recognised is the communication plan, both internal and external. Any change such as this can be quite destabilising on the face of it. And I've run a few of these internal and external communication plans myself on behalf of our clients. And you've got staff going, but what does it mean if we're owners? You know, do we have to put money in? What are our liabilities? What's happening to the managing director? What's going to change in the business? And actually, it's very difficult to find any negatives, but as I'm sure you're all aware, change can be very scary for some people. So it's important to get together a robust communications plan so that people feel completely comfortable with the new world. And of course, if you so wish to, an external communication plan is also really valuable. We've found it brilliant PR, not just for ourselves, but for our clients, because this employee engagement in businesses is seen as extremely attractive. And that's created great traction on social media sites, both for ourselves and for the clients that we've been working with. Poonam's going to pick that up a little bit now and tell you about how we actually work on our comms plan. But I hope you found that interesting so far. As you know, we said we'd be available to do some Q&A at the end of this, or just post things as we go along. If I can hand over to Poonam now, thank you.
Thanks, Jo. Hi, everybody. So yes, the next section, as Jo explained, is just to go into detail about the communication plan. We think this is one of the most important part of an EOT transition. Like with anything, planning is key, and ensuring that you have that staff engagement at the right time in the right places is really one of those high priorities on the list. Rach, can we just go to the next slide? So, you know, we've worked across different sizes of businesses, and what we know is that not one box fits all, and we have to create a plan that's going to be appropriate to your organization. So whether you've got 6 or 600 employees, we will look to build a plan that's most suitable for your business. That includes, you know, the values that you have, the tone of voice, the size, the structure, and in what scenarios do we want to actually share the plan that we do have in place with the different hierarchies of your business. In terms of the internal communication plan, you know, our plan will involve, and it involves EOT experts, which explain why the business is becoming an EOT, what is the company structure now, what will it be once the EOT structure has taken place, what does it mean for the vendors, what does it mean for the employees, you know, their risks, the responsibilities, any liabilities, and, you know, all the benefits that come as part of the EOT transition.
Can I just pause you one moment, Poonam? We've just had a question from Chris. So when you transfer to an employee trust, is it required for to be a representative of all employees or a selected group of management team? Are there rules on the percentage allocation of shares per employee? So guys, just to explain this, the shares are held by the trust, not by the individual employees themselves. However, you can make rewards based on one or all of the 3 following criteria: hours worked, length of service, or remuneration. And those criteria allow you to pay different dividend percentages. As I mentioned before, the first 3,600 is tax-free. Now, the reason it's important to note that it is the trust that own this is that when an employee leaves, they take nothing with them. You can also have a criteria that says not every employee can immediately be a part of this. So, for instance, in our business and in businesses that we've been working with, we've had a 12-month period where somebody's got to actually be working for the company before they can actually join the trust. So I hope that answers your question, Chris, and back to you, Poonam.
Thank you, Jo. So just where I was up to is, you know, a lot of employees will be concerned, you know, if we're going to become owners, what does that mean? Do we have to buy any shares, or what does it mean? And, you know, explaining that in detail in simplistic terms is really essential. And as Jo has just mentioned, those shares actually are owned by the trust on behalf of the employees. So you are only entitled to distributions as long as you are an employee and the company choose to make a distribution. When you're not an employee, you're not entitled to any distributions. In terms of control, Joe briefly explained previously that, you know, it is the directors that will remain to run the business on a day-to-day basis, and it's the trustee board that will make the decisions on behalf of the trustees. In terms of the day-to-day operations, they don't change, you know, unless there's any exiting shareholders. So if there's any exiting shareholders as part of this, then obviously the board of directors would need to be reviewed and implemented appropriately. The trustees of the EOT, Joe again has mentioned this previously, would include elements of directors of the board, and you can choose to have a employee representative on that trustee board as well, and it might be a rotating employee representative, but there's also the need of this independent trustee to bring that balance. And then the last thing is a handout of a document which explains to new starters what the EOT means. So again, we would include this in our comms plan, along with a frequently asked questions questionnaire to detail what each step means and how it impacts employees directly. So if we don't have that appropriate plan in place, there is a lot of negatives that can come out of that. So having that robust communication plan is key, because if you don't, you know, your business will not benefit from the wider elements of becoming an EOT. Staff are not engaged and they won't understand the benefits of an EOT. They also won't feel proud. Productivity will not change. So it's all the pros. The more staff engagement we do get, the more the performance of the company should change, because everybody does feel valued and they're working it together. And the more the outline changes from just a 9-to-5 job to actually, this is my business, we all need to be in it together, and we'll all be rewarded equally as well in a fair manner, because that's what the EOT does represent. So just going on to Chris's question about, you know, can it be a selected group or a management team? The answer is no, Chris. It brings in all employees, and really on that basis, the fairness of those 3 criteria works really well, because you can skew it on level of remuneration. You can work, you know, skew it based on any full-time or part-time workers. You can skew it on the length of service that somebody's contributed to the company. But if there's 2 employees both earning £30,000, both working full time, and they've both been there 5 years, the payment would be the same to them. It would be irrelevant that one's in admin and one's in sales, if that makes it simpler to understand. Brilliant. Thank you. And finally, you know, like I've already mentioned, based on the communication plan, we would look at the size of your business, how it's structured, what steps need to happen, when will this all happen, how will this happen, and we'd look at both internal and external, and we would put this all in a simple to understand plan, which will be on a step-by-step process, so we have all areas covered and ensure that transition is smooth as possible.
Thank you, Poonam. Just a quick question from David Maltby. Could the EOT decide to sell itself at a later date in a trade sale, for example? The answer is very simply, absolutely. If you think of the trust as being a shareholder, so clearly if the trust owns 100% of the shares, they can go out and look for a buyer, or somebody might approach them, and that has happened on a number of occasions. If, of course, they are only partial shareholders, so say they own the minimum, which is the 51%, then a buyer may be less interested unless, of course, the residual shareholders were prepared to sell at the same time. But if it was in everybody's interest to sell everything, then absolutely, both the trust and the original shareholders could sell at the same time.
We've just had another question, Joe, from Paul. Yeah. How are the funds from a trade sale distributed from the EOT?
Okay, and I'm presuming, Paul, what you mean there is if the EOT does a trade sale, so at some stage in the future, the EOT and or the residual shareholders decide to sell the whole lot. In that case, the beneficiaries of the EOT, who would be all the incumbent employees, would get a payout. However, that payout would be tracked as income tax rather than capital gains tax. I wouldn't worry too much about that, because I'm pretty sure that our friend Rishi is going to align capital gains tax with income tax. So of course, all the beneficiaries at the time of the sale will get a payout. Those beneficiaries who still own shares in the original business will of course get their payout. And if there is any capital gains tax in place, they will obviously get capital gains tax relief. Hope that answers your question, Paul. I think we're probably going to move to Paul at Keebles now, just to tell us about the legal process. So over to you, Paul.
Thanks, Jo. Rachel, if you could just move on to the next slide, please. Hello, everyone. My name is Paul Trudgill. I am a partner in the corporate team at Keebles Solicitors in Sheffield. I'm going to give you a little whistle-stop tour around the legal process in terms of creating an EOT and transferring the share capital of a company into that EOT. So first of all, we need to decide what the vehicle is for the trust. And Joe's already talked about a trustee corporation. It is possible to create a traditional trust, as you would probably recognise it, with a number of individuals actually holding the trust fund on trust for the employees, but we would recommend not pursuing that and actually creating a trustee corporation. That can take one of two forms, and it's a matter of personal preference, really, at least for the lawyers, I think, in relation to this. I almost always use a company limited by guarantee. So that is a company without a share capital, whereby the members of that company, those are the directors, have a commitment to pay £1 to the company in the event of its winding up. As another alternative, you can form a subsidiary of the target company. And this is the only exception to the rule that a subsidiary cannot hold shares in its holding company. But I would say that the company limited by guarantee is by far the more common structure used. Why do we use a trustee corporation? Two principal reasons. First of all, the trust itself, or the trust corporation, becomes the trustee of the EOT, and the directors of that EOT then therefore administer it. It's easier then to appoint and remove and retire those individuals from the trust board than it is to transfer the actual trust assets from one trustee to another trustee, if indeed you are going to have individuals holding it. So that flexibility of appointment of trustees, and just as importantly for the individuals, there will be a lack of personal liability for them for the assets of the trust, because the trust corporation is the trustee. So that is the entity which is fixed with responsibility for the trust funds. The individuals who administer that trust company as the directors simply owe the same duties to the trust company that they would already be owing to any other company of which they were a director. Now, how do we actually form the trust? Well, the company will create what's called a trust deed, and that deed creates the trust, it appoints the trustee corporation as the trustee, and it sets out the key elements of the trust. So what is the object of the trust? What are the powers of the trustee in relation to, for example, investment and distribution? It will also set out how and who qualifies to be a beneficiary of the trust. In addition to that, and this relates, I think, to a question which was asked earlier, how does the EOT actually get the money to be able to buy the shares from the exiting sellers? And as Joe explained earlier, it receives that by way of a contribution from the company of the cash that is available to be contributed to the EOT. So we put in place a deed of contribution. That deed of contribution not only covers the initial consideration that will be paid under the share purchase agreement, but it would also cover any costs which the trust incurs, such as stamp duty, and any costs, any professional costs, such as legal fees and corporate finance fees and so on. Rachel, could you move on to the next slide, please? So the transaction itself follows exactly the same format as any other share purchase or share transaction that you've seen in the past. So we would need to produce a sale and purchase agreement. That would be between the sellers who are selling and the EOT, the trust company. And that would set out the price and the structure for that payment. Joe also mentioned earlier reserved matters, and I mentioned this obliquely at the bottom of the slide in terms of minority protection. And Joe's absolutely right. In circumstances where the purchase price involves a significant element of deferred consideration, we would recommend that in those circumstances, the seller ought to take some form of protection which would ensure that the business is run in a way which doesn't put that deferred consideration at risk. Now, we need to be relatively careful here as to how we draft those provisions, because we're conscious that we don't want inadvertently to taint the tax treatment, which is one of the real incentives for using these kind of structures. And Russell will talk about that shortly. And so the way we do this is we include the kind of covenants and undertakings that you would expect to see in a sort of a facility document from a bank, because effectively the sellers in these circumstances are acting as the bank for the EOT and are lending them the proceeds to enable them to acquire the shares. And so you would expect a bank in those circumstances to seek to restrict perhaps capital expenditure or employee remuneration and other elements of conduct which might otherwise put payment of the deferred consideration at risk. We do on occasion put funding documents in place. So that's if funding is being made available to the EOT from an external party, perhaps a connected party. I've seen that come in from pension funds, for example. I've also seen high street banks increasingly start to think about lending money for the purposes of EOTs. They're feeling their way through that a little bit because it's new to them, and they struggle with the concept of the fact that the EOT is a holding company but doesn't actually form part of the group, and they have queries around security and so on. But I think over the time, they will become more confident with that, and we'll probably see more external funding coming into these kind of transactions. And also, and us lawyers get really excited about ancillary documents, and everyone else involved in the transaction has no idea why we prepare them, but we'll have stock transfer forms, we'll have shareholder resolutions, we'll have board minutes, we'll have powers of attorney, we may well have company's house forms, and so on if the constitution of the board of the companies are changing. My final point really relates to ongoing shareholder dynamic, and that is relevant to the extent that the sellers aren't selling 100% of the shares. So this is the situation where sellers are, for whatever reason, retaining a chunk of the share capital at completion. In those circumstances, clearly, therefore, we all have more than one shareholder, and we'll then need to think what the implications are for the ongoing relationship between the sellers and the EOT. And that ought to be reflected in a shareholders agreement. I think we'd advise against putting the reserve matters in the shareholders agreement, because that could potentially be interpreted by the revenue as creating some kind of control for the sellers as a shareholder rather than as a creditor under the sale and purchase agreement. And we'd also need to think about what the rules are relating to the transfer of the subsequent tranche of the seller's shares and any control which the EOT might want to have on a subsequent trade disposal. And also, and this is something that Poonam, Joe and I are seeing increasingly in this, there is, and this is sort of relates to one of the questions which was asked earlier about incentivizing key members of management. And it is perfectly possible to put in place a share incentive scheme at the same time or shortly after the EOT transaction goes through, whereby individual members or individual employees can take out options to acquire shares in the target company in the future as an additional means of incentivizing their own personal performance. In those circumstances, we would certainly need to amend the articles of association of the company to ensure that we cover off the classic situations of what happens if you have an employee shareholder who then ceases to become an employee, for example. And do we allow them to keep their shares, or do we require them to offer them for sale otherwise? So that's it. That was all I wanted to say. I hope that's been helpful.
Thank you, Paul. Just before we go on to Russ, you'd mentioned about sometimes it's a challenge for the trust companies to borrow money to pay the vendor out. Just to reassure the audience, we are not having too much pushback on this, provided, of course, that the vendor company has got the security available. So it is possible. It's just that most of our clients so far, including myself, because I'm continuing to work in the business, have decided that they didn't want to burden the trust with the debt. So they're taking it as a vendor deferred payment. But I wouldn't want anybody listening to this to think that it's not possible, because it is, and we're achieving that. So if I may pass you over now to Russ, who is our tax guru. Over to you, Russ.
Thank you, Jo. Good afternoon, everybody. I'm Russ Cahill, a partner at Tax Advisory Partnership. I've just realised the only downside of going forth on the rota for a tax-motivated structure is that by the time you get round to me, pretty much all of the tax issues have been covered off by everybody else. But I'll just go through the sort of headlines, I guess, to reiterate the key criteria and the key attributes of the employee ownership trust. And the main saving and the main tax benefit is for the existing shareholders of the company. And that is because, providing you meet all the qualifying conditions, then the sale of those shares to the trustees is done on a tax-free basis. And the way that actually works is that essentially it's what they call a nil gain, nil loss transaction. So that means whatever tax-based cost you've got in your shares, that is your deemed proceeds for tax purposes, regardless of the actual proceeds that you get. So by default, there is no capital gain arising. And that applies to both cash consideration on day one and all future deferred consideration. So it can all be wrapped up in the one transaction for tax purposes. And I think it was Jo mentioned earlier, I think the important thing to bear in mind is that really this is a one chance saloon. So the tax-free position applies to all of the sales to the trustees in that first tax year in which they gain control. So the rules say, did the trustees have control at the beginning of the year? No, because the trust didn't exist. Does it have control at the end of the year? Yes, it does, because it's acquired more than half the shares in the company. And therefore, all sales to the trust in that tax year can be treated as tax-free. So once you go beyond the 5th of April, any further sales to the trusts wouldn't be tax-free. That doesn't mean to say that you can't still use the trust as a mechanism for acquiring shares, but what it does mean is that any further and subsequent disposals to the trusts wouldn't qualify for the tax-free status for the vendor shareholders. And again, this has been touched on previously, but an important benefit for the employees is that they can get a tax-free bonus of up to £3,600 per annum. So notice it is tax-free, so it's still subject to national insurance, but essentially there's an income tax saving, an annual income tax saving for every single employee within your company. So that's not an insignificant amount if you can apply that to every single one of your employees. Essentially, the EOT is by default an employee benefit trust. It is a trust set up for the benefit of your employees. So it's directed by some certain regulations within the tax rules that essentially say that all payments to your employees by the trustees is deemed to be remuneration. So again, as previously mentioned, that means that any other distributions outside the specific exemption, that does mean that will be treated as part of the employee's remuneration, and therefore subject to tax and NIC in exactly the same way as any other bonuses and remuneration is. Again, Paul just touched on this, and I don't think this can actually be underestimated. I think this is a sort of very sort of powerful sort of mechanism to sort of effectively use the EOT as a acquiring vehicle for the existing shareholders, but alongside that, allow the next tier of management to effectively acquire shares in the company. And we would do that by making sales, obviously, of the shares to the EOT, but then alongside that, granting share options and ideally EMI share options, which themselves qualify for some rather nice tax benefits. The main one essentially being is that the employees can lock in today's value for tax purposes. And what that means is normally when an employee gets shares or share options, they're subject to tax on those shares when they receive them, based upon the difference between the market value of the shares and the amount they pay for those shares. And if you issue some ordinary or sort of unapproved share options, we have to look at the market value of those shares when the options are exercised and they actually receive shares in the company. Whereas with the EMI options, we can look in today's value, and any future growth in value is subject to capital gains tax rather than income tax, which obviously Joe mentioned that may change, but at the moment, and I'm pleased to say that there's been various announcements today, and capital gains tax has still avoided the headlines in terms of potential changes. So at the moment, there's still definitely a benefit of being within capital gains tax versus income tax. As I say, that can be very powerful. And we're working on a transaction at the moment whereby the existing vendors are looking to sell to the EOT, but actually they're bringing on 6 or 7 new managers or the next tier of management into the shareholding structure through the EMI arrangement. So that can be a great mechanism for effectively facilitating a management buyout. So that's something certainly to think about. And as I say, but having said what I just said a moment ago, I think it's fair to say that as I say, CGT has dodged the headlines at the moment, but we can't be certain that is going to continue for the medium term. There's a significant amount of debt that needs to be recovered through that's been taken out to provide the COVID-19 support measures. Capital gains tax is an obvious target, primarily because the manifesto commitments were to not increase income tax, VAT or national insurance. So obviously capital gains tax isn't on that list. So by raising it, they're not going to be breaching any, or Conservative government wouldn't be breaching any manifesto commitments. But also there is precedent from the 1990s and early 2000s where capital gains tax was aligned to income tax rates. And previously there was a Conservative government that put that system, that sort of regime in place. So there's precedent. It would raise money. It wouldn't be, I don't think, politically too damaging because it wouldn't necessarily be seen as a tax that affects the person on the street. So we can't outrule capital gains tax going up in the future. And we can't therefore outrule that the zero CGT rate, will be around forever. Obviously, that's you don't get any better than not paying any capital gains tax, and this is definitely an exceptional relief that is available. So we just don't know how long it will be available.
Can I just add something just to because as you mentioned, Russ, we're dealing on this quite complex. It's a quite a substantial business that we're working with on this, and it could be something that's pressing on the mind of some of the audience here. Is I'd like to reward some of my staff greater than others. I think it was sort of indicated in a previous question, and the EMI scheme that sits alongside the EOT allows us to do exactly that. Yeah. So you get the double whammy of everybody being part of it, but giving an extra reward through the EMI scheme. It does add another complication to it. It doesn't change the vendor relief at all, but it does create another incentive for the people that you want to just give an added extra to. And we're finding that this is actually very attractive when we started to explore it with people. So sorry, Russ.
No, you're absolutely right, Joe. It's a good point that there is. There's almost a matrix of things that we can do, yes. And the right answer just depends upon the specific circumstances of your company and your management team, and actually who you want to reward. But there's no perfect sort of one size fits all solution. It needs to be looked at on an individual sort of company and almost an individual company and then an individual shareholder basis. So again, it doesn't have to be that every shareholder in the company does exactly the same thing. You could have some shareholders who want to retire, but others who want to continue, and there is that flexibility as long as you achieve the main requirements, which
that's also a good point, Russ. Again, on another transaction we're dealing with, we've got some of the vendors who want to exit completely and others that don't. So I think Russ's words are perfect. One size doesn't fit all. I think Poonam said the same. It's about finding out what works to achieve your personal objectives and those objectives of your fellow shareholders, if you have multiple ones, and also how you want to reward certain members of the staff. So, Russ, I'll just pass it to you for the last slide.
Yeah, thank you. And I was just about to say there's sort of a huge amount of flexibility, providing you then get into sort of these, you meet the main requirements or the requirements. And actually it's hugely prescriptive, the sort of regulation, and it goes on for pages and pages. So there's way too much to cover on here, but we thought we'd just cover the headlines. Again, this has been mentioned before, but the trustees must gain control. So they must have more than half the shares in the company. And that's tested on several different levels. So it has to be voting rights, it has to be dividends, it has to be capital on a sale or winding up. So you can't use alphabet shares or different classes of shares to sort of still get a dividend income out for some shareholders and not the trustees. That kind of thing doesn't work. The revenue have very much looked at this. It's about fairness and parity across all shareholders. So the trustees must gain control, and that must mean control, voting and underlying economic rights as well. Critically, the company that is selling the shares to the EOT must be a trading company or the holding company of a trading group. So, that means that we can't have a property investment company or other investment company. That doesn't qualify. So it must be a trading company. And again, just a further point on the sort of fairness and parity, it has to be set up for the benefit of all employees. I can't remember if it was Joe or Poonam mentioned that. I think it was Joe that mentioned there are sort of some flexibilities within that, in that we can look at hours worked and remuneration and hours worked, remuneration and length of service. Yeah, so thank you, Joe. You can look at three flexibilities, but beyond that, everybody needs to be treated fairly. And then there's a requirement that you can't, it wouldn't work if you've got a large shareholder group that sort of represent a significant proportion of the employees. And this is really to stop the sort of personal service company or umbrella type companies from qualifying. So it needs really what they're looking at, that it's a proper business, with unconnected employees, and this structure is being set up, for their benefit. And it is, there's been a lot of questions about the sort of trade sale, and as again has been previously mentioned, there's absolutely nothing to stop a trade sale happening down the line, and they will happen down the line. That will definitely be the case. But the tax efficiencies are not necessarily sort of driven from that, because any payments from the trustees will be subject to income tax to the employees. Really what this is designed for is a long-term, holding structure, so that you are, it was the John Lewis model that was kind of banded when it was implemented. It's really about setting up the business for the long-term benefit of the employees. Having said that, it's a great structure for the existing vendors, the existing shareholders. It's an absolutely great structure to crystallize some value, de-risk, perhaps still keep some shares or incentivize the next tier of management. And actually, you generate your value on a tax-free basis. If you've established a business and worked hard to build it up, then why not? And the trust can be the holding company for the next sort of 4 or 5 years while you do crystallize that value on a tax-free basis. So so it's a great opportunity. As Joe said, we've implemented several of these just over the last 12 months, and I think there's many more to come over the coming years.
Thank you so much, everybody. And thank you for the questions that we've had as we've gone along.